All right, everybody, as you find your way to your seats, I have Philip Linton with Deveron.
Hey, everybody. Hope everyone's having a good conference. My name's Phil Linton. I'm the VP of Corporate Development at Deveron. Deveron is an agricultural and service data company. We were founded in 2017 and have really had a really interesting journey over the last 24 months as we started to really dive in on a very creative M&A strategy as we acquire the local relationship in agriculture and then building out a vertically integrated network of soil labs, agronomists, and wrapping it up with technology to increase yields for our growers. Everyone loves a forward-looking statement. Our mission is to help local agriculture achieve excellence by making impartial data accessible and useful. That kind of just sounds like a bunch of words, I know that. But essentially the relationship that happens right now is grower A every year needs to make decisions about what input, what seed they're going to use on their operation. And right now, they generally go to two places. They go to the local independent agronomist who has a 200-mile range around their operation to service that region, or they go to the ag retailer. You know, these seem like they probably wouldn't have any biases involved, but unfortunately, the ag retailer is really focused on selling whatever chemical, whatever seed's going to make them a bigger commission that month, while the agronomist is focused on a per acre basis model. And so every year, just for some background, every single grower in the United States and Canada that we would deem a sensible grower goes through this cycle. They plan for their year, they collect some data to understand what values in their soil. They then run that collection, that soil sample or tissue sample through a lab that then gets a prescription and some analysis so that they can operation and have a higher yield at the end of the day. And so what seems like a market that probably not a lot of people know about, 12 million samples are sampled and tested annually in North America. Right now, through our M&A strategy, Deveron controls about 11% of the total market share. And it has a pretty CAGR right now. Precision ag is at 15%. The soil testing market alone has been growing at 8% over the last 15 years with some really positive acceleration over the last 5 as we see people move to higher fidelity sampling. And so what we look at is that, what does 12 million samples annually mean? Well, through the actual process of going out into a field, digging a hole, bringing it back in a bag, and running it through a lab, it's, a really strong EBITDA business, but it's about $500 million annually. But what we've seen over the last little bit and through conversations we're having in the market is we're seeing more and more people move from larger scopes of testing. In Iowa, for perfect example, with one of these companies we were talking to that we later acquired in the end of 2021, just through the 6 months of conversations I've had with those people, they had their clients go from 5-acre grids, so that's 8 cores, which turns into 1 sample through a lab, every 5 to 10 acres. By the time the deal was done, and that was a 6-month period, they had 60% of their clients going into 2.5-acre grid or 1-acre grid. So pretty exponential growth when you look at what that turns into running into a lab basis. And so as we see more people go to best practice, which is about 2.5-acre grids, we can see over the next few years that this can jump into a really exponentially large market. And then from there, the fieldwork and testing turns into a $3 billion market. And so what do? We cover the whole vertical to help growers make decisions. So we do everything from going out and grabbing soil samples and tissue samples off of plants. We install weather stations. We fly drones. We help build that base layer. We have 3 labs across Canada and the United States that analyze those samples. And then we have a team of agronomists that are regionally located to help provide agronomic advice. But what this really builds is this really unique enterprise solution as we see the Bayers, the Cortevas, the large chem and seed companies starting to look at how they can use soil data to better understand their client, the market, and their operation. And so what does this vertical really add? To speak to what the market looks like right now, there's 120 soil labs out there. There's 14,000 crop consultants out there. That's a lot of room for marginal error through handoff. So our thought process is, how do you create a better decision is by creating a more standardized data set. And through controlling the protocols of the collection and the protocols and the standardization through the lab, we have really found that a standardized lab process, a standardized vertical can lead to a better decision for the grower. On a Deveron level, though, what it does, it creates this opportunity to capitalize on this huge amount of operational leverage within the lab space. The best way to think of a soil lab is, some fixed assets, some mildly specialty labor, and really, as long as the machines are running, you can keep running samples through them. So as we start to grow these businesses and control the throughput, we see this increasing incremental margin as we run samples through the lab. And what it does for an enterprise-based solution is, and we saw this for when everybody jumped into agricultural carbon, is it gives the enterprise a one-stop shop. As enterprise started to get into the carbon space on benchmarking for their own ESG initiatives, they would put out an RFP and 17 different advisors would come in saying, we could touch Iowa and we can touch Kansas. And Deveron came in and said, we are the only ones that can touch all 17 states. We can handle your soil lab capacity, and we can digitally distribute it to you right through our API. And so the unique thing about this business is as we continue to run samples through the vertical, as we see this creeping incremental margin happen. Field services is, the boots on the ground, muddy people on a ATV driving through. We generally see about 65% margin on that. Testing and insight, we see at the base level 75% at labs that are generally at 60% capacity, so we can see higher. And as we get into an enterprise solution, we look at about an 85% gross margin. And so this is an example of our network. So over the last 24 months, we've done about 10 acquisitions, 3 of them in the lab space, 6 in the agronomy and crop consulting space, and 1 as a tech company. Within these acquisitions, we are now capable of covering all of the cropland in the United States. We are still acquisitive, still want to buy more because at the end of the day, you're buying that regional relationship. But what it has done is given us the capacity to run about 1.2 to 1.3 million samples annually. These 5 agronomy or 6 agronomy locations also are able to provide regional input, which we still view as very important, mostly because the relationship at the end of the day relies on the region. It's people at the coffee shop that have worked together for 30 years. And our viewpoint is that won't go away with technology, but technology can enable those people to increase their productivity and have a larger effect on their customer base. And so we've really been acting on this big consolidation opportunity that we see. As I mentioned, there's about 14,000 of these agronomists. There's 140 soil labs, and their main pain point comes down to time. They're small mom and pop shops. They, also take out the trash. They do all of the invoicing themselves. They've all built these small little tech systems internally to keep it going, but they're leading everything on it. So as we bring them into the fold, the first thing that we're really doing is aligning them with our tech platform for how people move and aligning them on our centralized services so they get 30 to 40% of their time back to either continue to upsell their customer base, take on a handful more customers, which they were fearful of doing before because they would limit their ability to provide service, but really grow through that. And currently we're seeing about, on average, a 25 to 30% year-over-year growth after we acquire these companies. But what we really get out of this is this great vertical network that we can then start to look at the soil lab for these companies as less of an expense and more of a revenue opportunity that generates a whole lot of operational leverage to act upon. And at its core, as I mentioned, this is a little bit of a relationship business. This is rural America. I've taken more regional flights that are 1 hour long and been more turbulence than probably most of the people in this room combined. Don't envy me, it's not fun. But when you get there, you can truly see that it is this multi-generational connection between the agronomist and the grower. We acquired a lab called Frontier last November. There's a lot of them, so I'm running out of how many we've done. And Jim, who's the owner, bought the business from his dad. And at that point in time, one of their clients happened to be the 3rd generation grower that they had dealt with on the same field. I selfishly don't think an algorithm can take that away in one day. And so our M&A strategy is generally pretty accretive. We buy these companies at 2 to 5 times EBITDA multiples. As we look at how this company grows over time, we started to change how we pay out. We used to be 50-50 cash to equity. Now that we're looking to be less dilutive to provide more value to our shareholders, we're starting to lean a little bit more on cash and leveraging them out with some of our relationships at the bank. But at the end of the day, we pay it out over 3 years. And with this model, what we're generally finding, which is kind of unique, is based off of the growth and what their EBITDA margin is, the free cash flow from these operations are paying off their second and third year earnouts. Here are all of the recent ones we've done over the last 16 to 18 months. But the unique thing is that there's no limit to this. As I said, I'm the fun person that gets to do these events, gets to go meet all these smart entrepreneurs in different parts of the world and take a bunch of regional flights. So right now we've built a pretty amazing pipeline. When I first started doing this, I live in Toronto, for people who don't know. A 647 area code from Toronto calls an agronomist in Iowa. It probably seems like I'm going to try and sell them duck cleaning or something like that. But what we've seen is more people start to pick up the phone. We've seen a lot more drive. So right now, in terms of deals that I can act on in the next 3 to 6 months, we have about $16 million in acquirable revenue. And that's generally sitting at about a 25 to 27% EBITDA multiple. We have about another, that number needs to be updated, about $50 million in annual revenue that we could acquire over the next 12 to 16. And what we're really seeing is it's really starting to work. We just put out our preliminary Q4 with our earnings results, earnings coming out tomorrow and our call on Friday for those people who want to join. But we're really starting to turn a corner. We're seeing for Q4, we saw about $15 million in revenue and about 4.3 in adjusted EBITDA. But we're seeing this productivity really start to grow through using our technology platform to help move people around so that we don't have 2 of the same Deveron branded trucks that would service different clients, before they came on board. And logistically finding the value of being efficient there. Our infield services is now what we would call a scalable solution for enterprise to go collect their soil data needs, as we can touch all acres across North America. And it's really given us this opportunity to really play in this derivative and carbon space that not many people can, based off of, it is costly and timely to scale up a labor force at the end of the day. But providing single chain of custody for the vertical allows us to play with the enterprise companies and start to have conversations with new client segments, including, large chem and seed, but also Schedule I banks in Canada who have the largest agricultural lending books out there, and crop insurance companies that don't yet, but are starting to think about how agricultural data can actually de-risk their book. Obviously, we've had a lot of growth over the last 6 years, with 2022 being pretty aggressive. We have about a 5-year CAGR of 126%. We are very heavy in the lab business since acquiring our largest acquisition to date in May of last year, called A&L Labs. They did about $26 million annualized revenue. And so you'll see that the revenue split and the revenue per country will be skewed to be data insight in Canada based off of that transaction last year. Currently, we touch about 25,000 farm clients through all of our acquisitions and all of our organic growth. And we look to continue to grow organically and through our M&A initiatives over the 2023. Here's our cap table. We are pretty tightly held. Management controls about 40% with insiders and strategic investors. We have a handful of institutions in the stories, and then our retailer other is, generally held by a few high net worth people that are taking reps. Our board is very well experienced in both the tech, agriculture, and public markets, which is a hard thing to find. And we are very proud of our leadership team up there. And so the key themes to take away is, this is a really fragmented old world industry that's pretty ripe for consolidation and for disruption. There aren't many people looking at the space because it's not as exciting as some things are. But in PE world, it's too small of a check to write. So this consolidation opportunity for these, smaller EBITDA positive businesses is huge. And we really are excited to continue to consolidate, continue to push through organic growth, and continue to execute on this, huge operational leverage opportunity within our labs. And that's it. anyone has any questions, I've got that down pretty quick these days, so I know we have some time. Yeah. Yep. And so the question is there fixed infrastructure with as we acquire labs? And yeah. And so as we acquired A&L recently, we were able to essentially part of the deal was a chunk of property that was valued through TD at about $8 million. So yes. Yeah. So and mm-hmm. So, I mean, I guess it was earn out, but those that, you know, or kind of look to relationship with. Yeah, so the question is there any risk once the earnout ends of the customer leaving based off the relationship? And the really interesting thing about how we've acquired these today, and this will be a little bit of an anecdote, because when we started down the M&A path, we were going through and saying, oh, well, you know, people don't want this business anymore. You're probably not going to be able to sell it. You're going to retire and the business is going to be dead. And as we talked to more people, I would get the same answer from a 65-year-old man. He said, no, I'm going to keep doing this for another 10 years. I'm happy about it. And so what really started to connect people was our mission. And I think that's one of the reasons why people join with us at the end of the day is that these are people that live agriculture for the last 40 years, and retirement is almost scary. They just don't know what to do with their hands. So generally we have more people stay on than, well, we haven't had anyone leave yet, but we generally have more people stay on just based off of that it is in line with what their goals are. It's just a step above and beyond that 200-mile region that they were touching before. And so there's always going to be a little risk. We haven't experienced any yet based off of alignment on mission and values. Hope that answers your question. Anyone else? Okay, I think we all have 10 minutes back in our day. Oh, we got one more back there. There is a target number of labs based off of region and your ability to continue to operate them at maximum capacity. And that is generally going to be based off of, right now we have about 3 that are all in separate regions. We could probably theoretically tack on another 5 to 6, depending on the size. There's a handful of these larger labs that have multiple locations. Then we would feel we had good operational capacity to handle as much at our current needs as well as any other acquisitions that we see in the short-term pipeline. But really at the end of the day, you have this opportunity to acquire capacity through the soil lab, which is a little bit of a relationship business, but then you can kind of reverse the strategy on its head, go back to focusing on crop consultants and samplers that use that lab, start to attract 100% of their revenue as well as internalize it into your own system, and then start to position it as acquiring additional crop consultants. So a little bit. I forgot to say the question there. So the question was, is there a number of acquisitions that we see where we don't see the efficiency anymore? So right now what we're doing is we're aligning with our banking partners to do some debt is part of the strategy right now. As you know, I think as we start to become more cash flow positive, the conversation will be a little bit, less on the debt side over time. But currently, as we have the relationship growing, that's one of our strategies to make it less dilutive. Okay. So when it comes to the lab, so the question being, can we start to hub and spoke it a little bit more? Can we ship them to different locations? the three most important things in this order to the grower right now in terms of their lab relationship is timeliness, price, and then quality. So right now, to be competitive in the market, you kind of have to be within a sub 3-day turnaround. So a big part of how we acquire labs is actually viewing it through a shipping pattern of what can we get done within a 1-day window there and back. And so theoretically, as you can, but you still have to be regionally focused. So you can generally what you start to see is more of a drop-off posts with larger hubs, but you would still need kind of that minimum to get full coverage, about 5 to 6 in the US. In Canada, you probably need one more. The radius all depends on the shipper that you use in question. So we generally work a lot with UPS and FedEx, and then we follow their guidelines for 1-day turnaround. Yep. So the question was, with the acquisitions, are we doing it with cash and stock? Cash or stock. So right now, generally the way that they're done is they're paid out evenly over 3 years. Upon signing, they would get 33.3% of the stock up front. That's secured at the price, 33% of the cash. And then as they achieve their earnout goals, that's how they get paid out. The second question was the nature of the convertible debt. As we acquired A&L, to get that deal across the line, we ended up having to go for a convertible debt facility that is held within 8 investors that are long in the story already. So we do feel comfortable that we can actively call those people easily. Okay, we lost our 10 minutes, down to 3.